Hello everyone, this is Dr. Mahmoud Al-Odeh. In this video, I'll be talking about inventory management. Inventory, let's define inventory, a stock or store of goods. So if we store a product or an item, that's what is called inventory. And there are different types of inventory. There are dependent and independent. The independent items, these are the items that are ready to be sold or used. Dependent items, these are the opposite, that are not sold. We use it to build the independent items. Why this inventory management is important? It's important because 30% of current assets for organization consists of inventory. Therefore, we have to manage it very carefully. And inventories are important in every business, and it will help any business to make sure that the customers are satisfied. Different types of inventories. We have a raw material and purchase parts, and we have a work in progress inventory. We have finished products and inventories or merchandise, tools and supplies. We have maintenance repair inventory. We have in transit inventories as well. So hopefully this chart on the right side will help you to identify some of these inventories. So for example, from the supplier, you will have the raw material goes down, you start working on it. In here in the middle, that would be work in progress. And then we have inventory as a finished products, and then we send it to the warehouse. That's where you will see between the finished product and the warehouse, there will be some transit. And also there's another transit work inventory is between the warehouse to the customer. So along the line from the supplier all the way to the customer, there is an inventory, and therefore we have to be able to manage this inventory. Inventory as I mentioned, it's important for any business and will help businesses to meet customer needs. Also, here are more functions for inventories. Inventory will help you to anticipate, to meet the anticipated customer demands. It will help you to smooth production requirement. It will help you to decouple operations. It will protect against stock outs. Also will help you to take advantage of order cycles. It will also help you to hedge against price increases. So if you haven't, about the price will increase, so maybe we could store more items. It will help you to permit operations, and will also help you to take advantages of quantities discount. So sometimes we have some offers and we need to take advantages. So therefore, the best way to take advantages of these discounts would be through inventory, buying more to reduce the cost. There are different categories for inventory costs. These are item costs, and these are the prices paid for the item, for the purchased item. There's also carrying cost, the cost to carry and hold the product in your warehouse. That would be considered as a capital. The cost of capital, which is the money invested in inventory, is not available for you. Storage cost, which is also, this is based on the space, workers, and equipment that you need for your warehouse, and the risk associated with storing these inventory, such as damage or misplacing or damaging the inventory. The third type of inventory cost is the order cost, which include the setup, tear down, purchase order cost, which is order preparation, follow-up, expediting, receiving, authorizing payment, and accounting. These are all kind of order costs. Also, there's something called lost capacity cost, which is the time taken to set up to set up an order. It will be lost as a productive output time. So the worker who's working for you, and that person wanted to work on the setup, that would be a lost time as a productive output time. Also, there is a stock out cost, which is the back order cost, lost sales, and possibility of losing customer. These are the different kinds of items that we need to talk about it. We will use it in just a second in different equations to calculate the total cost for inventory. First parameter for inventory that we need to use, first factor that we use in inventory management, is inventory turnover ratio. And this is the ratio of of annual cost of product sold to average inventory investment. And we need to know how many times a year the inventory is sold. And the higher number that we get, that would be the better, which means that you are using a more efficient way for your inventories. You're utilizing it very good. So in order to calculate the inventory turns, would be the annual cost for the product sold divided by the average inventory value, the average inventory. And also another parameter that we use, it's called the days of supply, how long this current inventory will last to reach to level 0 or to a safety stock level. That would be inventory on hand divided by the average daily usage. Let's take a look into this example and the impact of the inventory turns in a company. If the annual cost would be, the cost for a product sold is 24 million and the average inventory is 6 million. Therefore, there are 4 inventory turns. By dividing the goods sold, product sold, 24 million divided by 6, that would give you 4 inventory turns, which means you have to fill your warehouse 4 times in order to fulfill the customer needs. However, if there is a production system has been installed and this system can satisfy the customer with only 2 million on average inventory, that will increase the inventory turns to 12 inventory turns, which means there are $4 million in reduction in inventory. We've reduced it from 6 million in the inventory, average inventory, to 2 million inventory. So we've saved 4 million as a reduction in inventory. Of course, the inventory turns increased because you will have to order more to fulfill your customer's need. So if the average total cost of carrying inventory is 25% per year, the saving for this company, it would be 25% times the 4 million. That would be equal to 1 million as a saving, just because we reduced the inventory from 6 million to 2 million based on a 25% carrying cost. Carrying cost is basically the money that you have to pay for renting a warehouse, hiring people to take care of the warehouse, insurance, etc. So that's usually considered or used as a percentage, and in this example is used as a 25%. Now moving into the next topic, which is the method to evaluate cost inventory, and this would be first in, first out. This is assume the oldest items, which is the first in stock, will be used first. And this is important, not important, it's just the feature for the first in, first out. In rising prices, replacement is at a higher price than assumed cost. This method does not reflect current prices, and replacement will be understated. The reverse is true in falling price markets. So again, what you would do, you will have to replace these products at a higher price, and does not reflect the current prices. And sometimes replacement will be understated. So basically, sometimes we used to fill this warehouse within 1 million. Now, because the prices increased, need 2 million, but on paper and what we've known, it's 1 million. Another technique to evaluate the cost of inventory would be last in, first out. Last in, first out, assume the newest item in the stock will be used first. In falling price market, existing inventory is overvalued. So the only disadvantage for it, or the downfall for this technique, is when the price decrease, the existing inventory is overvalued. All right, now moving into the next methodology to evaluate the cost would be the average cost, which is an average of all prices paid. The problem with this method is in changing prices, rising or falling, is that the cost used is not related to the actual cost. Sometimes, once we change the price, you're not going to get the accurate cost for. for it. And the last method to evaluate inventory would be the standard cost, which is cost determined before production begin, and that would be basically calculating the direct material, direct labor, and the overhead. And any difference between the standard cost and the actual cost is stated as a variance. So these are just a few techniques to evaluate the cost of inventory. Now we're going to move into a more advanced technique, which is called the ABC classification, the ABC classification system. And I would like to move it to another, I would like to start another video to explain this concept. So I will see you in another video. See you.